And welcome to ETF Edge. It's your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. Markets are bouncing back today after a rough Friday. Better than expected U.S. manufacturing data also helping the markets today. Joining us, Jeff Kilburg of KKM Financial, Jeremy Schwartz, he's the global head of research at WisdomTree, and Professor Jeremy Siegel, senior investment advisor to WisdomTree, and a professor at the Wharton School of Finance. But you all knew that. Professor, let me start with you. A quick thought on the coronavirus and where we stand. We're already seeing some declines in first quarter earnings estimates for some of these global cyclical sectors like materials, industrials, energy, hotels, for example. What has to happen with this virus to stabilize the market, in your opinion?
Well, Bob, we know in the short run, fear and greed, momentum players, they dominate the market. Sometimes greater than reality. Really, how serious is the coronavirus? There's a lot of debate. At this point, I look at death rates and say it's not much different from other influenza, but others say that it could get worse. So, there's been a huge reaction, the shutdown in travel, and obviously that affects entertainment and airlines, and that fear can keep on generating, and then who knows? In 2 or 3 weeks, we can say it's relatively contained, death rates are low, not much more than others, and then we'll get a relief rally from that. But it's impossible to tell how long that will take.
Yeah, the good news is the death rate seems to be low, but the incubation period may be long, so we may have a lot of people that are being affected. You have pointed out before that the market leaders this year are defensive names once again. So utilities and long-term treasury bond ETFs are leading. Both of them are up nearly 7% of the year. That's outperforming everything else. But will that not change if the coronavirus suddenly becomes less of an issue? They're not going to be buying defensive stocks necessarily, are they?
They will not be buying defensive stocks or treasuries hand over fist, Bob. But nonetheless, you are seeing attracting assets to these two sectors due to the reason we don't have clarity. The lack of clarity, that's corrosive. And what is that doing? It's attracting assets coming in. Look at the 10-year note. We're in 125th day in a row, being our 2%. It's trading 153 right now. But on the flip side, the utilities, it's interesting to see. Yes, we have seen a big boost due to the coronavirus. But if you go back 3 years, Bob, it's been 3 years neck and neck to the S&P 500. So I think this search for yield, this global search for yield persists.
Yeah, I think that's the important thing. This is, even if you look at relative strength indexes, utilities held up all last year. So you can't just say, oh, this came out of nowhere and utilities have been suddenly outperforming. You're very big, Jeremy, of course, on yields. And you've been pointing out, too, that a better way to play this, frankly, given utilities are so darn expensive right now, maybe high yield, maybe yield stocks at this point.
Usually utilities have this above average yield characteristic, and when we look at the average dividend paying stock, we have a total dividend index, 1,500 dividend paying stocks. It's got the same yield as utilities, sort of 3% average yield, but instead of being share issuance, there's 2% net buybacks. They're 3 or 4 PE multiple points lower than utilities. So I'd rather get the total diversification, the same yield, but they're doing buybacks. So I think that's a better play, the average dividend paying stock, than utilities.
And you're very much on top of this over at WisdomTree.